Hi, it's Arjun. This week, we continue our series of 30 years of perpetual transition with a focus on the energy sectors or subsectors, various business models, and how strategies for companies have changed over the course of my 30-year career. Now, we said it last week as a reminder, we recognize the term energy transition has become a loaded term that to most people today means we are somehow transitioning from fossil fuels only into renewables and over some arbitrarily short time frame like by 2050. There is no part of that we agree with, that we think is on track, or that we think would be good for human prosperity. That is not what we are referring to. We are referring to the fact that the business is always changing. The macro changes, the sectors change. Last week, we focused on the energy macro, used the example of oil demand and how the key regions have shifted from back in the start of my career in the 90s, Europe, Japan, and the Asia tigers and tiger cubs being the key area of focus, to clearly in the 2000s, China, and perhaps some of the other big BRIC countries with the US being the core drivers of growth. Energy is a constantly evolving business. This week, we want to focus on sectors, strategies, and business models and how they've evolved. And with that, we'll get into the video. So I'd like to start by going through each of the major traditional energy sectors, all of which have undergone dramatic change just over the course of my 30-year career. Let me start with the integrated oils. This used to be a sector. When I was at JP Morgan on the buy side and when I launched coverage in 1999 at Goldman Sachs, there were something like 13 integrated oils. Today, there's only two, the last two in the US, that is Chevron and ExxonMobil. But at the time, we had Chevron, Exxon, Mobil was a separate company, Texaco was a separate company. We had Amoco, Arco, Conoco, which had been spun out from DuPont, Kerr-McGee, Marathon Oil, Murphy Oil, Oxy, Phillips Petroleum, Unocal, and I probably have forgotten someone in there. They all had upstream, downstream operations. I don't recall in my career Kerr-McGee or Oxy having refineries, but they all had some notion of other businesses, could have been chemicals, could have been midstream. And of course, when the business started 100 years ago, and through much of the subsequent decades, if you were going to be a large crude oil producer in particular, you wanted to have midstream and downstream offtake to ensure those barrels found a home. And that probably stopped mattering many, many, many decades ago. But it wasn't until the more challenging times post the 1986 bust, and especially during the 1990s, that investors started saying, hey, are you sure you have the scale and competitive advantage to be an integrated oil? And of course, we saw a huge wave of consolidation, which I'll get into in a second, kicked off by BP and Amoco, that led to the market and companies putting themselves in one of two buckets. You're either going to be a super major, try and compete with ExxonMobil and Royal Dutch Shell at the time, or you were going to separate your upstream from your downstream and so forth. And the term was, the first decade of the 2000s, it was coined by Steve Chazen, the legendary CFO and then CEO of Oxy. The late, great Steve Chazen, I should say, was that the integrated oils were disintegrating. I thought that was a very funny quip, classic Steve Chazen. But regardless, dramatic change for the integrated oil sector. I want to say the refiners are the most transformed group from the start of my career 30 years ago to today. This used to be a low return backwater for a lot of those former integrated oils, and actually was one of the catalysts for restructuring to either get size and scale, a la, again, ExxonMobil and Shell at the time, or splitting off into independent companies upstream and downstream. There was structural overcapacity in the 80s and 90s. That did slowly go away, so we've had a little bit more of a margin tailwind. But we've also had companies that have been focused on the business, that have had acquisition strategies, acquire and improve, some amount of business transformation, focusing on returns, focusing on dividends and stock buybacks. And this has gone from really one of the worst performing subsectors within energy to actually being the leaders on profitability, on stock price performance. It's a remarkable transformation for a sector. And the whole nature of being an independent refiner, that really wasn't a thing 30 years ago. And now it's been one of the most important subsectors that I think is on track to remain so. I want to highlight the midstream space and really what I think was a seminal event. And this is my perspective as an analyst. When Rich Kinder left Enron, I want to say it was 1998, and formed Kinder Morgan, it was a dramatic change for both the MLPs, which I want to say were created as part of the 1986 tax law change under President Reagan, and were kind of sleepy. They were for retail investors, to really being a strategy in and of its own right, focusing on distributions first and foremost via these long-lived, low volatility assets, the pipeline business. And that opportunity always existed. There were other great companies, both in that era and today, folks like Enterprise Product Partners, Energy Transfer, ONEOK, Williams, Plains All American. I know I'm forgetting a bunch, El Paso. There are a bunch of different pipeline and MLP type companies. But Rich Kinder leaving Enron, and for those of you that don't remember and only know how it turned out, Enron early in my career was a tremendous company. They had some of the best and brightest people working there. Some of them you'll still find throughout industry. But when Rich Kinder had a falling out with Ken Lay and Jeff Skilling, Rich, as I understand it, wanted Enron to focus on the pipeline assets, the hard infrastructure, and pursue some version of a distribution strategy, which is what, of course, he did at Kinder Morgan, where Skilling and Lay wanted to go in a different direction. We all know that did not turn out well for Enron, the parent, but this was once a phenomenal company. And that it was just a huge inflection in the fate of the midstream sector and actually Enron. And look at what the MLPs are today. They have shown the way for the sector on how you go about having a distributions first strategy. The super majors have always cared about dividends and stock buybacks. They've generally grown over time, but it was never the core focus of those companies. They were all about generating advanced returns from a portfolio of global assets, taking advantage of where integration can make sense. I will say the pipelines and MLPs have been specifically a shareholder distribution first strategy via the nature of the assets they have. And I want to certainly credit Rich Kinder as an analyst for kind of ringing the bell, so to speak, that a new sector was here that institutional investors should focus on. In my 30-year career, I've been one of the people in the camp of E&Ps need to better focus on profitability. Classically, the E&P sector has been one of cycle leverage. You're bullish on oil or natural gas prices, you own E&Ps, or for risk-taking, wildcatting, exploration, you can make a big discovery or perhaps engage in an acquisition. But profitability was always secondary or not particularly focused on. And that's changed. It's changed for the better. I will say, though, when you look at E&Ps and they're focused on profitability, you still need risk-taking. And I think that's the go-forward question. We've now fixed the fact that the sector's focused on profitability. We've fixed balance sheets. But most E&Ps do not have long-lived assets like a pipeline or MLP company does, or even a super major does. So there is a need for some element of reinvestment and risk-taking. And I think that's where we are in terms of go-forward views on the E&Ps. What is the nature of risk-taking going forward while still prioritizing profitability? I think the last space I wanted to talk about is new energies. And as a reminder, I covered new energy companies in the 2000s, biofuel, cellulose, ethanol. I touched upon that last week. Today, we have a whole different version of these same types of companies. And I got to say, and I think it's the word of the day, it's always been, and I apologize, a weird space. People want to call it clean tech at times. And I think they want to get the term tech in there. And I think there's some wish casting that we want this to be like the technology sector that we all love, the Microsofts or NVIDIAs or any softwares. And that's not the nature of new energies. It is hard to crack the code on what is going to displace oil, gas, and coal. It's not easy. It's never been easy. And we're still waiting for dominant companies to emerge. Now, even a space like solar, which to its credit has grown a lot, you have not wanted to buy and hold US solar companies. They've traded for sure. But exactly how you play, maybe it's the industrial space where there are some interesting examples of companies that are doing things that are part of the solution, but we're still waiting for this sector to grow up. I don't know if that's the right word, to have some dominant companies to profitably scale. That is what we are waiting for in new energies. So I want to highlight on this slide my 4 favorite business model or strategy changes. I have a couple of honorable mentions as well, but things that when they happened, it was not obvious this was the route to go, but once the company went down that route, either everyone followed or it became obviously the right way to go. The first example, I've mentioned it before, was this person I'd not heard of at the time who came along and started Tosco, Tom O'Malley, and said, I know everyone hates refining. I know it's perceived as a low return business you don't want to be part of. But if you buy the assets for pennies on the dollar and run them well and run them for cash flow and free cash flow, you can make a lot of money. And Tosco was one of my first big calls at JP Morgan Investment Management at the time. And of course, Tom led the way to really transforming a sector that, for the most part, didn't exist. And I do think Bill Greehey at Valero deserves another sort of founding father status of the modern independent, we'll call them downstream companies today. But that model of buy out of favor refined for pennies on the dollar, it was a transformational business model. It didn't exist, to my recollection, before Tom O'Malley started it. Everyone ended up doing it. And this sector has gone from nothing to really being the highest return on capital, best performing sector within energy over the last decade. Remarkable. Shrink to go. I'm going to say restructuring has always existed, but I want to specifically call out Oxy here, which for those who weren't around in the 1990s, prior to Steve Chazen becoming CFO, Oxy, and I think it's okay to say this, they were a disaster of a company. A whole bunch of assets scattered all over the world. They had pipelines, they had E&P. None of it was very good. And they needed to restructure. So they were doing some good restructuring steps. But the idea that Dr. Ray Irani, who was a controversial CEO at the time, to his credit, he really turned around the company, but at the time that was not obvious. They did the idea that he was going to pay a premium price for US onshore Texas, in this case, the Permian Basin assets, in 1999 or 2000 or whatever year it was, and to pay what at the time, all of us analysts that covered said they need $20 oil to make this acquisition work. And again, this was a disaster of a company that, again, had done some good asset sale steps. They bought this Altura from BP Amoco and Shell, I want to say, were the joint venture owners. And that was a time where everyone knew you did not want to be onshore and you wanted to be international offshore. This is not the Permian Basin of today when they bought this. It was very out of favor then. And we all were convinced. At Goldman, we had a $17.50 long-term WTI oil price. People were a little more bullish at $18.50. The bears at 16. We used to fight over 50 cents or $1 per barrel. And here comes Ray Irani with his disaster of a track record saying, I'm going to pay $20 oil for these mature assets from two great super majors, BP Amoco and Shell. And he was the last person laughing. Oxy was a home run stock after that. Clearly, the super cycle helped. It suddenly turned out that the Permian became a hot area. We didn't even know shale oil was going to exist for another 10 years. And you look at Oxy today, they're still benefiting from this foundational investment. And it really was just a dramatic strategy change that all of us on Wall Street were against at the time. If there were 30 analysts covering Oxy, I'm going to give two credit for having had the correct call that this was a good deal. One was Jay Wilson, who is the JP Morgan sell-side analyst. You all probably know him as an executive at Hess Investor Relations. And the other was John Mahady of Sanford Bernstein. I think he is still on the buy side. Two tremendous analysts at the time, great people still today. They're the only 2 out of 28 who got this call right. I got it wrong. This was a terrible call for me. Oxy was a home run stock. And it was really a dramatic change that Oxy took at that time. When BP acquired Amoco, the second that was announced, you knew the world was going to be different for the super majors. And it was only a question as who was next. I think most people know this story. This was starting the wave of taking 13 US integrated oils down to 2 in the US, and we can add the 3 in Europe, BP, Shell, and Total. And credit to Lord Brown, he kicked this off with what was a tremendous acquisition of Amoco. I think the fourth one I want to highlight is in many respects the most amazing, because Enron Oil and Gas, or EOG Resources as it's now called, was a successful company. It was successful as part of Enron. It was successful once it was spun off. Forrest Hoagland was a tremendous CEO. Mark Papa was a tremendous CEO. Mark and EOG at the time were big in natural gas, and they were very successful during the initial shale gas revolution. And I will never forget, I can't remember if it was 2010 or 2011. It was the first year at Goldman we were allowed to go back to Miami for our conference. We were exiled to Tampa, not for cost reasons, but because Goldman didn't want to be perceived as having shindigs on Miami Beach. It was a serious conference, but anyway, perceptions. We were back in Miami, and I'll never forget Mark Papa at the keynote presentation saying, shale gas is over. There's too much of it. We as a company are going to shift entirely to shale oil. Now, many of you today will say, yeah, of course, shale oil was the future. No one knew it at the time. It was unknown. There was essentially zero shale oil production. And here you have Mark Papa, the CEO of a very successful E&P, EOG Resources, declaring the future was going to be very different. And to his credit, and I hope I'm remembering this correctly, he did talk about the fact that it was going to take some time for a company like EOG, so weighted to shale gas, to shift over to shale oil. And perhaps Harold Hamm and Continental was doing it. They weren't a public company, I think, back then. But it was really a pioneering move. It's an example of risk-taking. It's an example of going to where the puck is going to be, not where it was. And I can still remember Mark Papa. I can still feel like I can visualize him saying these words, shale oil is the future, and that's where we're going. I want to give honorable mention to 3 other companies. I'll try and keep these briefer. The first is with exploration in Anadarko. When they were spun out of Panhandle Eastern, I want to say that was 1986, they were a domestic gas producer. This is pre-shale gas. It was domestic conventional gas. And the idea that a domestic gas producer would decide to do exploration and oil exploration and perhaps go to some foreign country like Algeria, which at the time was in the midst of a major civil war between various factions in Algeria, was, I mean, can you imagine a company doing that today? Imagine any current gas producer, domestic, saying, I'm going to go explore for oil in XYZ African country. They'd get demolished. But here you had Anadarko doing it, and it was a massive success. I believe I was on the original analyst meeting visit to those Algerian assets. It was Paul Taylor was IR. It was John Hurlin, the Merrill Lynch analyst, myself. I want to say Mike Hensley of, I think, State Street. And I want to say it was Bill Sullivan who escorted us as the Anadarko executive along with Paul Taylor to those assets. For me, I was at JP Morgan Asset Management. Aside from Tosco, this was my other big stock, and it was transformational for Anadarko to have been part of this discovery. Risk-taking always is needed. I want to give Cheniere credit. I'm of the view that you basically have to be a super major, or let's just call it $100 billion plus company to be in LNG, and I think that's still largely true. But here you had, under Sharif Suki, Cheniere originally created because we thought the U.S. was going to be short natural gas, so it was set up as an import strategy. And of course, they transitioned to being an LNG exporter, tolling, and so forth. And they are the exception to the rule. They started as a very small company. They've had tremendous success. Cheniere shows that you don't have to fit just one model. And again, I would never have predicted this success. I still believe you need to be essentially a super cap, super major type company, but I clearly would not have been wrong, or I was not right in forecasting Cheniere's success. I think the last one, I will highlight just some of the downstream spins that have been really good. Murphy USA, Marathon Petroleum, and Phillips 66 out of the then integrated oil ConocoPhillips, all examples of pretty big business model changes. And I think all these 3 spinoffs have done exceptionally well for shareholders post the spin. So what can we take away from these business model and strategy changes that we've been talking about? I think the first is the most impactful changes were not obvious at the time. They were unexpected. And the leading companies did not stand still. BP was a leading company at the time, and their purchase of Amoco took things to another level. EOG was a very well-regarded, very successful E&P company, but Mark Papa did not stand still, and so on and so forth. Risk-taking is a core element to mega success. We're coming off this period where traditional energy has suffered, returns on capital were poor, the S&P weighting's way down, and people have been mad at the companies and they're demanding all money go back to shareholders. I get it. Profitability absolutely has to be better going forward, but you do not sustain profitability. You do not become a great company by not taking risk. And risk-taking is the key to, I'm going to call it, having mega success. The Tosco, the EOG into shale oil, Anadarko and exploration, and so forth. Competitive advantage and focus evolve. It's usually not about replicating yesterday's strategies. It's about figuring out what's going to work going forward. And the question is always, what is the next great business model that we're not thinking of today? The next resource opportunity, the next technology example that's going to unlock either some new form of energy or some existing resource in a play we can't imagine today. That is what we are striving for as advisors, as board members, as investors, as executives. So I want to talk about how you think about bucketing companies into what do you want to be as an entity. So when I think about the types of companies you can invest in, one is the buy and hold type company. That was the super majors historically. I think it's still the super majors, but I would now throw the midstream companies and downstream into that bucket now. Downstream companies are certainly inherently more volatile, but they're starting to earn the right to be in that kind of buy and hold, long-lived assets, distributions are the primary focus type bucket. You can certainly be a cycle leverage play. That was classically the E&Ps. They're moving away from that, I think, for good reasons. Perhaps it's the merchant power producers today. Max leverage to the cycle, always sort of an opportunity for investment. What are the new business models? It used to be, whether you're an E&P, I think about Apache under Ray Plank. I certainly think about XTO as an example. or the Toscos and Valairs of the world, to sort of acquire and exploit or acquire and improve. Those were both revolutionary business models when they occurred. What's the example going forward? Is it some intersection of gas, renewables, and power? I personally find very intriguing what Total's doing on that front. But I put a question mark there. I don't know what that next great, remarkable, oh my gosh, the world has changed business model is, but that's what we're going to try and figure out. And certainly, what is the next great resource opportunity? Now, I'm showing here oil and gas resources. It could be a new technology. When Suncor came out in the 1990s, it really revolutionized oil sands as an investable area of operations. You then had shale gas in the 2000s, shale oil in the 2010s. And the question is, what is next? I'm very skeptical that we know today some new energy technology that is going to be truly profitable and scale up and displace any of these existing traditional resources. Before the traditional resources, what is the next area you want to be in? The Permian Basin is going to remain a great core asset for the companies that are there. But what else is out there? Where should we be looking? And I think that is what we're going to spend most of our time striving to evaluate. So just a final slide on this topic. And so we've spent a lot of time talking about energy's S&P weighting. That's the purple line on the right axis. It peaked in 2008. We're up off our lows, but still not anywhere near where we used to be a decade plus ago. But I also want to highlight the number of stocks, energy stocks in the S&P 500, because it goes with this concept of risk taking. You can see there's some cycle, it's shallower to it. But when the sector underperformed in the 1990s to the low places during the internet bubble boom, the number of stocks, energy stocks in the S&P 500 fell from nearly 30 or really 30 to the low 20s. Then as the cycle recovered, and frankly, even past peak, you saw the number of energy companies, the S&P 500, double to a high of 44, and that year was 2013. And now we're back near an all-time low, and there are two companies in the existing 22 that are slated to be acquired. If or when those deals close, we would be at a new all-time low in the number of energy stocks in the S&P 500. I think just a few key takeaways. When you have the number of companies shrinking, when you have consolidation, it usually goes with an expectation of more bearish outcomes. It does not mean every M&A deal is defensive, but there is a notion, well, I need size and scale. I need to, make it through the volatile times or what have you. And consolidation in that respects, without an IPO cycle, without new ideas, without new business models, is one of defensiveness and negativity, to be honest. And I think the question is, it does not have to be the existing companies. It does not have to be the existing sectors I've even mentioned. But what is going to cause this number of companies to go back up? It may trail the S&P weight. If we're being a capital markets person, you probably need interest to come back in the sector, but it's going to go hand in hand with having a positive equity story. And it's go hand in hand with new ideas and new business models, of which I think we're still searching for maybe it's in the power space. Maybe it's the merchant power producers. Maybe I should figure out a way to include more than just the kind of oil and gas and refining names and pipelines are in here too, in this exact metric. But we're looking actually for the number of companies to go up. And I'm going to say the outlook for energy is positive, all forms of energy. We're going to have growing demand for as long as we can think. The returns are going to be better. The profitability is what I mean. And we're going to get new companies. So I'm going to say we are at or near an all-time low in the number of energy companies, S&P 500. And by a decade from now, this number will be meaningfully higher. I'll come back with a specific prediction at another time. So I'd like to end this video on a personal note. And I want to stick with the theme of 30 years of perpetual personal transition. I just want to provide kind of some different perspectives that I've gained from each of my major career stops. So I started at Petrie just out of school. That's where you learn work ethic, what it means to actually be a professional, and trying to get an edge on your knowledge base as a research person, that you're not just trying to take the average of what everyone believes, but you're trying to have a differentiated view. At JP Morgan Asset Management, my second stop, that is where I use this mindset as an equity analyst. You're just trying to be right. I learned that on the buy side, where it did not matter how great my analysis was, how charming or persuasive my writing or speaking style is. The stock either outperformed or underperformed. You were either up or you were down. You either outperformed the index or you underperformed it. Whatever your metric or benchmark is, it was much more black and white. And you quickly learn. It really doesn't matter what your personal views are. It doesn't matter how great your analysis is. You actually are just trying to be right. This picture, by the way, It's the cover of my launch report from Goldman Sachs, and then more recently myself at an OPEC meeting. So that's what the picture is. My third stop, Goldman Sachs. I could probably do an entire video on what I learned there, but I think a couple takeaways for me. The benefits of a global team were really pronounced at Goldman. So as my career was kind of gaining steam at Goldman, as we started making some big macro calls, this notion of the super spike era and the super cycle, I spent a lot of time with our China economists and analysts. It was, I want to say Hong Liang was our chief China economist at the time. Someone at Goldman can correct me on that. But I believe she was the chief economist during the 2000s. And between her very insightful views and then our on-the-ground teams, I think they were probably in Hong Kong, not Beijing at the time, but the steel and metals analysts in particular, I gained a lot of insight on where the Chinese economy and Chinese demand. And this was, of course, a major inflection on the macro. We went from Europe, Japan, and Asian tigers to suddenly China. There was a lot of skepticism from many people, and I credit that global team with really helping me there. I think the other big thing I benefit from at Goldman was the global client base. So as an equity analyst, you spend most of your time talking to fellow energy equity analysts, and it can be a little bit of a bubble, a little bit of common speak. And to have had like the distressed credit guys call me, every time refining crashed, I would hear from the distressed credit guys. It always made me feel good that I knew we were near the bottom of the cycle, especially if I had hung on too long and still had some buy recommendations. And that's, again, probably for another video. I can still remember a meeting with some of the macro traders. These are some of the most prominent people that all of you names would recognize on the street, kind of near the peak. This is the first peak in oil, 140, 147, where this was not my client base. One of the key salespeople asked me to meet with them. I'm not turning it down. These are all household names. And I remember the comment, Arjun, you've had a great call. Everything you're saying now, we were still bullish, is logical, but it sure seems like you're fighting for the last dollar when the bulk of the money's been made. I mean, it's just such a, obviously correct with hindsight, but it was correct at the time perspective on the energy macro. Those are the kind of things I got to benefit from as a Goldman analyst. I think that then leads me to the final career stop prior to Veritain, which was 10 years of board and advisory work. And on the one hand, I've gotten to deal with two public policy shops, Columbia and ClearPath, and to understand that world, hugely beneficial. To interact with environmentalists at some of these places, people with very different worldviews than I have, hugely beneficial. I think what it means to be a board member of either a private company, a public company, or an advisory board member, and really understanding that distinction between being on the front lines as either an analyst or a manager versus being a board member where it's a governance role, it's an advice role, and it takes a while to understand these distinctions. You're not running the company. You're not an analyst making calls on what companies should do or not do, but you do provide an important governance functions. You do see the importance of the head of that organization, whether it's the CEO or head of the policy shop or head of the private equity company, whatever it is, being critical, and then the team underneath them and the culture of both the management team and the entire company and how the board itself has all those things are fascinating to understand, and I've been blessed to have benefited from. And I'm trying to take all that, all those kind of 4 different tracks in my career and bring it to this super spiked and Substack and to Veritain and all of our partner companies. And with that, we'll see you either in 1 or 2 weeks. Thank you.